Hi, everyone. Thank you for joining us today. I'm Marcia Butler, the webinar director at Advice Chaser. We're so glad to have you here. And as you're coming in the webinar room, and before I introduce our guest, I need to do a bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars, such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. We're thrilled to bring you today's educational presentation. Attendees are muted, but we do encourage you to ask questions using the chat box, and the presenter will answer those queries during or after the webinar today as appropriate. If you ask a question in the chat box, go ahead and leave your phone number as well. And if we can't get to your question during the event today, we'll make sure someone reaches out to you afterwards. We want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. Well, I'd love to introduce you to our speaker today. James J. Tavares, AIF, is a co-founder of Lodestar Wealth, an investment fiduciary specializing in retirement planning for business owners and their employees. Lodestar Wealth is a public benefit corporation, meaning it aims to provide a positive impact on society in addition to turning a profit. James majored in business economics at Brown University. James began his investment management career in 2006. His professional focus is on retirement plan consulting and individual wealth management. Before moving into financial services, he was enrolled at the PLME program at Brown University's Warren Alpert School of Medicine. He's an ardent believer in outcome-based consulting, tailoring his recommendations to the goals of his clients, supported with data-driven insights. And James, I know that we have a very information-rich presentation here today, so let's go ahead and launch into that, turning the time over to you now.
Thank you, Marcia, and thank you for the team at Advice Chaser for inviting us to be a participant in this webinar. I love your legal disclosure because I've been known to make a number of terrible jokes, and I'm glad that you don't co-sign on my dad jokes.
All right, there you go.
Yeah, that was probably one of my prouder days becoming a dad now that I could officially make dad jokes. Again, we have a deep presentation, and you provided a wonderful introduction to me, so I won't go too deep into myself other than Lodestar Wealth is, again, it's a registered investment fiduciary that really specializes in holistic corporate retirement planning. In the old days, that meant just consulting on a 401k and really the particular portion of the 401k, which was just the investments. As the industry has grown, and more importantly, as the needs of plan sponsors have changed, we've evolved to offering plan design, consulting services, and really consulting also on health savings accounts, as they're an important part of the retirement plan process. Today, we're going to talk about Secure Act 1.0 and 2.0. And so in terms of the agenda, before we get into the meat and potatoes of those two pieces of legislation, I think it always helps to understand the backdrop as to why Congress felt these two pieces of legislation were needed. So we'll start with the need for change, then getting into Secure Act 1.0 and spending most of our time on Secure Act 2.0. And lastly, we'll finish up with some best practices that will allow for the business owners on this call to help adhere to the new provisions. So with that, why the need for change? And really, it comes down to two words: coverage and usage. What do we mean by that? And let's start with the term coverage. Coverage describes the number of Americans who have access to or are covered by a 401k plan. Now, this is an important issue for Congress, as the 401k or similar plans like the 401k have really become the dominant vehicle for savings in the United States. So if we're going to help Americans prepare for retirement, we need to ensure that there's an appropriate amount of coverage. So as we can see on the next slide, there's currently 739,000 combined defined contribution or defined benefit plans in the United States today. Now, while that seems like a lot, right? A lot of plans out there, that number is actually essentially flatlined since the mid 80s. So we haven't seen much change in new companies offering retirement plans, or often cases we'll see smaller companies offer a plan and determine after a few years that they can't afford one and terminate the plan. So this has really led to a coverage issue. Those 739,000 plans cover 64% of Americans. So 64% of the working force has access either to a 401k, a simple, or a pension plan. Few and far between these days with the pension plans. So really, again, speaks volumes to the amount or lack of coverage that we have for the workforce. As we get deeper into the usage issue, we'll talk about the fact that only 52% of Americans who even have access to a plan are participating in their plan. And our best estimates say that 57 million Americans do not have access to a workplace plan. So really, that's a problem for Congress. As we think about future generations and their ability to live without government support in retirement, we need to provide access to those 57 million who don't have a plan currently. When you look deeper into the coverage issue, you'll find that it's felt hardest in the small business world. So 33% of employers with fewer than 20 employees offer some sort of retirement plan. Contrast that with the number of employers who offer a plan, a number of large employers with more than 5,000 employees, 98% of those employers have a retirement plan. So we really have an issue with small businesses not feeling as though they're either equipped enough or with enough knowledge, have the right fiduciary protections in place, or can cover the cost of starting a retirement plan for their employees. The coverage issue is further exacerbated by the issue of demographics. So this is a survey from the US Census Bureau. This is their 2021 survey of income and program participation. And from that survey, we see that the likely owners of a retirement account, a 401k or something similar, tend to be white, male, baby boomers. Women, millennials, and people of color are underrepresented when it comes to retirement account ownership. Furthermore, surveys have shown that with women and people of color in particular, when they do have access to a plan, they actually participate at the same rate as white males do. So the government, Congress views this not as an issue of do we need to educate certain portions of the populace or what are we doing to help certain portions of the populace, but in reality, we just need to make retirement plans more accessible for businesses that are employing women, millennials, people of color, so that way they can have a plan and participate as well. The usage problem really underscores the savings crisis that we have in the United States. This comes from a great survey from the Hartford on the future of benefits. And from that survey, we found that 50% of Americans report living paycheck to paycheck. Only 39% of workers have $1,000, or I'm sorry, 39% of all workers have less than $1,000 saved. And that's not just for retirement. That's for an emergency, a healthcare issue, my car breaks down, right? So these are staggering numbers. As we talked about earlier, only 48% of workers with access to a retirement plan are even contributing. Many of those workers aren't contributing because they feel as though they can't afford to save money for retirement, especially if they're living paycheck to paycheck. Of the 52% of Americans who are actually participating in their plan, nearly a quarter of them have taken some sort of loan or hardship distribution from the plan. That's not what retirement plans were designed for. They were designed to put money away, invest it, hopefully it grows, so you'll have that nest egg for retirement. But many of the folks that are saving are having to tap into it because of a lack of an emergency fund. So this has become a major issue for Congress. We need more people with access to a plan, and we need to design plans in such a way that employees feel as though they can afford to save, and then maybe even have access to those assets to encourage them to save. The federal government has begun tackling this problem with the Secure Act 1.0 and 2.0, but we've also seen a shift in state mandates as well. So states have begun tackling this problem, and they're doing so by requiring employers to have a retirement plan. The map illustrates which states already have active legislation. Those are the states in dark blue that require plans to either already have a plan or in the near future have a plan in place. I'm sorry, employers to have a retirement plan in place. The states in light blue have pending legislation requiring retirement plans for small businesses. The states in gray haven't quite thought about that just yet. In most instances, states that are requiring employers to have a plan will either require them to have a 401k, SEP, simple, something along those lines. And if not, they've created their own state-sponsored plans, which we'll discuss in a few minutes, as an alternative. So it's really put the emphasis on having these plans. As a business owner, why is it important for you, outside of these legislative mandates, to be concerned about this retirement savings crisis? And it really comes down to the cost of delayed retirement. 90% of employees surveyed are not confident in their retirement security. Savoya had a great commercial a few years back that showed individuals walking around with a number under their arm, and that number was supposed to reflect their cost of retirement. And I love the commercial because there was only a handful of people that had a number that was somewhat exact, but a number of people that walked around that just said a gajillion, right? And it really underscored the fact that most people don't know what retirement's going to cost them, what they'll be spending money on, and more importantly, where they'll get that income, right? So if employees aren't confident in their retirement, what are they going to do? They're going to work longer. So 88% of all plan sponsors have reported employees who are delaying retirement because they're just not prepared, right? Either they don't have enough saved, or they don't know if what they have saved will get them over the hump in retirement. As a small business owner or business owner, that's important to you because each year that those employees work, they become more expensive, right? So $50,000 is the cost of a 1-year delay in retirement per individual employee. That 50,000 would probably pay the cost of most of your 401k plans in totality. All right. And what that number is derived from, it's from a survey done by Prudential, covers sick leave, medical leave, healthcare benefits outside of just salary. Right. So that's an
Okay, I was
important
just going
piece.
to ask that, where that 50,000 came from.
Yeah. So that's the cost of all of the ancillary benefits, ex salary, of having somebody delay retirement. Obviously, healthcare gets more expensive the older you get. So that's a critical piece of that. 1.5%, that's the average annual incremental increase in workplace costs for a 1-year increase in average retirement age. So if you have an average retirement age at your company right now of 62, if you were to bump that number up to 63, it'll cost you an additional 1.5% in your total workplace costs. More importantly than just the money, especially for the small business owners, is the paternalistic feeling, right? No one wants to see employees that they've come up with, nurtured, delay retirement because they don't feel as though they're financially secure. So this is critically important. This is the backdrop for why Congress felt they needed to act with the two pieces of legislation that we're going to discuss now. So getting into the secure overview, let's start with Secure 1.0. which some provisions have already been made irrelevant by Secure Act 2.0. That's how quickly things are moving in Washington these days. So Secure Act is an acronym that stands for Setting Every Community Up for Retirement Enhancement. This was passed in 2019, December of 2019, bipartisan legislation, which was great to see both sides of Congress get together to put out an important piece of legislation. They did so almost under the cover of darkness right around Christmas time. with an implementation that started just a week later. So it really didn't give much of us in the industry time to digest all of the provisions, but we're happy to report that most of them were, beneficial to employees and employers. The major provisions of the Secure Act, and we'll go through this a little faster now that we already have 2.0. But the first thing that the Secure Act did was raised the required minimum distribution age to 72, up from 70 and a half. So for those individuals who are retired and have a traditional IRA, they're no longer required to start taking distributions the year in which they turn 70 and a half. They now have up until 72. For business owners that are working, same thing, 72. The age limit for IRA contributions has been removed. So this is, again, part of helping people save for retirement. You can save in your IRA at any age now. So continue working, continue putting money away. Inherited retirement account distributions must be taken within 10 years. So that's a way of clawing back some of the taxes that are associated with inherited IRAs. Prior to Secure Act, you had a number of different formulas that you could use that would allow for you to bleed out the amount of time that you took money out of your inherited IRA. That's no longer the case. So that's Congress's way of getting a little bit of tax revenue back from this act. A great new provision allowed for new parents to take penalty-free withdrawals, and adoption is now included. So if you've been saving for retirement in an IRA and you're now looking to adopt, adoptions can be very expensive. Your IRA can now be used to take penalty-free withdrawals. There's still income tax associated with it to cover the cost of adoption.
Yeah, that was something I was going to ask, is that if there's still, regular taxes.
Yeah, we're waiving the 10% penalty rule in this case. And as we'll see with Secure Act 2.0, that's expanded to from not just the adoption rules, but to other withdrawal scenarios as well.
Mm-hmm.
The long-time part-time employees rule, and we'll get into this in greater detail in just a moment here, means that part-time employees are now eligible to participate in a 401k plan. Before business owners get too worried about what that means in terms of their match, this is a deferral only provision. So prior to Secure Act 1.0, plan sponsors had more discretion in eliminating or discriminating against part-time employees for being eligible to the plan. Secure Act 1.0 and now 2.0 have removed some of that discretion. And then the last thing that it did, it was introduced the pooled employer plan, which is an enhancement to the MEP plans that existed previously. And this allows for small companies to join up into one larger pooled plan, regardless of association with the other companies within the plan. And we'll talk about this in greater detail, but it's another way to make retirement plans more accessible at the small business level. 2.0 was a massive piece of legislation that was signed into law on December 29th, 2022. There's 7 titles, 77 individual sections, 90 plus provisions. We could spend 7 hours going through everything. I'm not sure I could actually go through all 7 titles with any degree of certainty. There's just so much information in there to digest. But it was a great way for Congress to build on Secure 1.0. And again, going back to what we talked about with the coverage and usage problems, the focus of Secure 2.0 is on assisting employers in launching new plans and then encouraging employees to save more for retirement. So really trying to get at the crux of this coverage and usage problem. There's both mandatory and optional provisions as it relates to plan design that we'll discuss. And parts of the law have gone into effect immediately in 2023. Some stretch out as far as 2033. So for the purposes of our conversation, I've broken down Secure 2.0 into some immediate provisions, some future provisions, some new things around plan options, and then some of the great tax benefits that are made available now to small business owners. So let's start with the immediate provisions put in place by Secure 2.0. So the first is that RMD age that we just got used to, 72, is now 73. So things move fast in Washington. Our new RMD age, and this goes into effect immediately, is now 73. 10 years from now, it'll be 75, assuming no changes are made to that. If you are contributing in a plan and you're still working, you are not subject to RMDs. So older employees that are still working aren't forced to take distributions out. What this rule was really targeted at is business owners, key employees. So as a business owner, you are required, even if you're still working, to take out an RMD. In the hopes that more business owners will continue to launch plans or not terminate plans, by delaying the RMD age, it allows for business owners to contribute, to continue putting money away without having to take money out and paying the income tax associated with that. So that's a mandatory provision that's in effect immediately. An optional provision that's come about is the ability now to provide small token gifts to employees for enrolling in a plan or attending a meeting. So prior to Secure 2.0, this was viewed as a prohibitive transaction. You weren't able to bribe people into putting money away into their 401k, or at least showing up to the meeting. The best you could do was, if you're an HR director and you wanted people to show up to the enrollment meeting, was give them some donuts, right? And hope that the donuts worked. Unless they were the best donuts in the world, it really didn't matter, right? So now you do have the option. It might be something as small as a $5 gift card to a local coffee shop, but you'd be surprised how far those small incentives go in at least getting people to the meeting and possibly enrolling in the plan. So this is another way to encourage usage of the existing retirement plans. The long-time part-time provisions have already been adjusted. So what Secure 1.0 did was to have any employee who's considered a long-time part-time employee. And what does that mean? Someone who worked 500 hours in 3 consecutive years for an employer was now eligible to defer only to the retirement plan. So as a business owner, you were not subjected to having to match those contributions for part-time employees, but you could no longer exclude those longtime part-time employees from participating in the plan. Secure 2.0 has decreased that holding period from 3 years of consecutive work, 3 consecutive years at 500 hours, to 2 years beginning in 2025. So as the first 3 years will ultimately phase out, starting in 2025, the new provision will be 2 years for the longtime part-time employees. In addition to longtime part-time changes, CITs are now available to be used in 403B plans. So 403B plans are restricted to nonprofit agencies and churches, governmental institutions. Prior to this piece of legislation, they could not invest in collective investment trusts in their plans. Collective investment trusts are mutual fund-like vehicles that are available only to qualified defined contribution plans, and in many cases have lower expenses and other additional benefits. So we have now made those investments available to 403Bs. This is immediate, with a caveat that in doing so, Secure Act 2.0 provided for the use of CITs, but it actually conflicts with some existing securities law that's on the books. So this will be available, not yet. And I think that's kind of a good example. We'll talk about best practices down the road of how these things, often evolve over time. So you have this big piece of legislation that was passed at the 12th hour or the 11th hour, put into place, and we've already found some conflicting pieces within it. So all the more reason to kind of stay in tune with what's going on. Hardship certifications. I think this is a great one. Hardship certifications can now be self-certified. So a plan sponsor in the past was responsible for determining whether or not the hardship that a participant was experiencing was in fact a hardship before allowing for the hardship distribution. From this point on, plan sponsors no longer have to do any investigative work, so you're not required to be a Sherlock Holmes. As long as the participant self-certifies, and the key portion of this provision is that you don't know anything to be, contrary to that self-certification, you can allow for the hardship distribution. So as long as they don't tell you that they went out and bought a PlayStation 5 with their hardship money, you don't have to be any wiser as to what the hardship was used for. The idea again behind this is let's reduce the administrative burden in having a retirement plan, which will hopefully encourage more businesses, particularly small businesses, to launch a plan. And that's also true for the next provision, reduce plan notices. So once a participant has been made aware of their eligibility in participating in a plan, you are only required to provide them a single document annually reminding them how awesome their retirement plan is and that they're eligible to enroll and they should really consider enrolling. So the summary plan description will normally do that, right? Providing that means less paperwork, less cost associated with that paperwork, and fewer administrative burdens, and again, having a plan.
Previously, how much reminding were they required to have?
So it was a reminding on all of the pieces for any plan changes for the eligible employees that weren't participating in the plan. So changes to plan description and the like.
Okay.
The next three are critically important, so we'll make sure that we have a full understanding of them. The first, and this is an optional provision that Secure Act 2.0 allows for, is Roth matching and non-elective, so safe harbor contributions. So prior to Secure Act, any of these matching contributions that you did to your 401k plan were done as a traditional contribution. You now, as a plan sponsor, have the option of making those contributions as a Roth. Now, this one is interesting because I think it opens up a bit of a Pandora's box as to some potential unanticipated or consequences associated with the provision. The first is because Roth dollars are after-tax dollars, they cannot be subjected to a vesting schedule. So oftentimes plan sponsors will encourage employee loyalty by vesting out a schedule for the match, right? So 25% of your match is available in year one, 50% year two, so on and so forth. You can't do that with after-tax dollars with a Roth. So it's critically important that if you're going to undertake a Roth contribution, you understand that that's the case. Second piece that makes this a bit of a Pandora's box is that this is after-tax dollars. So for the employers that are receiving, the employees that are receiving a Roth match or non-elective contribution, those dollars are reportable as W-2 income, right? So you don't want any tax surprises when they get that nice Roth contribution and realize they owe money on that. So that's critically important. The third is that most record keeping systems and third-party administrators are not really ready to handle this new provision. So while it's gone into effect right now, it's not something that you're likely able to adopt right away. And that I would, given that this is a bit of a Pandora's box, I wouldn't be surprised, and we've advised some clients maybe don't think about this provision just yet, but we'll know that it's available and put it on the back burner for future conversations. What will be mandatory going into 2024 is that all catch-up contributions for highly compensated employees must now be made as a Roth contribution. So highly compensated employees is a number that's determined by the IRS. It's indexed each year. I think for this year or in 2024, it'll represent anybody who's making more than $145,000. Highly compensated also covers key employees. So ownership, children, spouses of owners, those are all considered for the purposes of this provision, highly compensated employees. So those employees that are older than 50 and are making a catch-up contribution, that contribution has to be a Roth contribution. So it has to go in after tax.
So that's just saying that they will have to pay tax on that the year that they make that contribution.
Correct. So this is when you look at the way Congress does its budgeting, they do so in extended periods of time. And anytime money is made as a traditional contribution, it's viewed in their budget as sort of a tax loophole and lost revenue. That's money that they could have taxed, but they've given somebody an opportunity to avoid taxes on that. This is another way to claw back some of the lost revenue associated with all of the other provisions. Why, even though this goes into effect in 2024, why I discuss it as an immediate provision, this means that your 401k plan will need to have a Roth feature in place once this provision goes into effect. So if you have a 401k plan now that does not allow for Roth contributions, you'll want to think about adding that sooner rather than later. This also will have some unique impacts on plans that fail, a unique impact, sorry, on plans that fail their ADP testing. Catch-up contributions are used as a way to recharacterize contributions for plans that have failed. So now those contributions will be made as a Roth, and you'll have to go through all of the associated loops and hoops, I'm sorry, with that. So a very important provision. And then the last immediate provision to consider is that for those who have a simple or a SEP plan in place, you can now make those a Roth simple or Roth SEP. What's not totally known just yet, and even though this is again an immediate provision, is whether or not those plans will be subject to the income phase outs that traditional is not the right word when using, but the old school, I should say, Roth IRAs, the existing Roth IRAs are subject to. So in a qualified retirement plan, a 401k plan, there are no income limits. You can, regardless of your income, contribute your salary, your deferral as a Roth contribution. You can do so up till the full 22,500 contribution limit for 2023. We don't know if that's going to be the case with Roths. I'm sorry, with simples and SEPs. So will you be subject to the income phase outs, or will you be capped at 6,000? To be determined just yet. So quite a bit in terms of immediate provisions. Some of the key future provisions, and again, we're not going through everything in here, but these are probably some of the ones that will garner the biggest headlines going forward. So for new plans, anything that has been created post 12/31/2022, new plans will require this enhanced automatic contribution arrangement. And you must adhere to this new provision by 2025. So any new plan that's written today by 2025 has to adhere to this new provision. And what this new provision will do is it first and foremost will allow for returns of contribution up to 90 days. So if somebody enrolls in the plan, starts contributing and decides they want out, you have 90 days to return those contributions or for them to make that decision. In addition to that, it requires that auto enrollment be a staple of all new plans going forward. And that auto enrollment can start at 3%. It can't be anything lower than that. So you must have auto enrollment at least 3%, with auto escalation designed to be 1% annually up to 10%. So by 2025, any plan that's written today or thereafter will have to adhere to these provisions. It also requires the use of a qualified default investment alternative, which we think is a great feature to have. There are some exemptions to this. So if your company has not been in business for 3 years, you're exempt from this provision until you've reached that mark. If you have less than 10 employees, you're also exempt from this provision until you have your 11th employee, and then by the following plan year end, you'll have to adhere to this new provision. And then there's some churches and some other governmental institutions that are exempt as well. So this is a big one, and this is really getting at that usage issue that behavioral finance tells us that if we auto enroll employees and we auto escalate them, they traditionally don't change from those features. So this is a great way to get more Americans actually saving for retirement. Another interesting one that's come about is the student loan match. So we hear from a lot of plan sponsors that the millennials and the Gen Zs that are working for them aren't contributing to the retirement plan because they can't afford to. And that's largely because they're paying so much in student loans. So this started with a qualified letter to one business that allowed for that institution to actually match against student loan contributions. And from there, it kind of blew up where everybody said, well, that sounds like an interesting idea, especially for the larger employers. We'd like to consider that for our plans as well. So beginning in 2024, plan sponsors can match against student loan payments. So let's say your employee shows that they're paying 5% of their salary towards their student loans. You can count that as a contribution to their retirement plan, even though it'll show an actual zero, and then match against that 5%. Now, the devil will be in the details here. How do you actually verify that? What does it look like? So we have a little bit of time, but this is a great one to help the younger generation who has been slow to save for retirement actually begin to participate in their plans. And also for employers these days, everyone's looking for a way to differentiate their company and their benefits offering. This is another unique way for you to do that.
And just to clarify, that the company is matching into a retirement account, not matching a student loan payment to the student loan servicer.
Correct. Yep. So that payment that the employee is making to their student loan servicer is being viewed as a contribution to the retirement plan, and then a matching contribution is made to that retirement plan, even though no actual real contribution was made. Thank you for that clarification, Marche.
Yeah, I mean, as I was reading through that, I thought, oh, that could be tricky to educate people about, because it's not going into the same bucket.
Yes. So this is again, this is I view this one as a way for employers to differentiate their benefits offering, more so than it is to necessarily encourage additional participation in the plan. We want to help you. We'd love, for you to participate in a retirement plan. We understand why you can't, but here's a way for us to make a matching contribution to at least what you're paying in your student loans to help you prepare for retirement, and to hopefully use that as a nice way to recruit young talent while also tackling the savings crisis. Some of the other provisions, simple conversions. So beginning in 2024, you can terminate your simple plan and have and launch your 401k plan in the same calendar year, which was not possible. This may even actually go into effect with any luck later on this year. So companies that have realized they've outgrown their simple for one reason or another don't have to wait the full year to make the switch to a 401k plan. Emergency withdrawals, and this goes back to, again, encouraging people to save in their plan. What Congress has done through these next set of provisions is allowed for you to almost think about your 401k plan as an emergency account in addition to a retirement account. This goes against what I talked about previously about having, too many loans and hardship withdrawals out there. But if it means that more people will participate, then it's a step in the right direction. So beginning in 2024, participants can take a $1,000 withdrawal pre-age 59 without paying the 10% penalty. You can only do this once every 3 years unless you've paid off that distribution. So you can't constantly be taking out $1,000. There's no verification requirements at the plan sponsor. So this is really designed, when we talked about folks not having any money saved for emergencies, your engine goes out on your car, you need some work, I need to take money out, you can tap into your retirement plan, no questions asked, and tackle that actual emergency. In addition to that, beginning in 2024, plan sponsors can offer the emergency savings account pension linked feature to their plan. This one is, there's a lot to this. So the simplified version is plan sponsors can offer a Roth contribution that's the lesser of 3% of salary or 2,500. So it's capped at either 3% of salary or 2,500 for their employees. And this is for non-highly compensated employees. So if you make too much money, you're not eligible for this provision. Once the account grows greater than that 2,500, you'll then have to roll the rest of those assets over. This is portable, so this is a Roth contribution that can then be rolled into a Roth IRA. and essentially another way for employers to encourage enrollment and participation in the plan by tackling that lack of emergency fund problem for most Americans. This will again be a heavy lifting provision, ensuring that the employees don't have more than 2,500 in those accounts, that the assets are being rolled over. So something definitely to think about, but not probably something that you'd see a whole lot of heavy adoption in right away. But another, feature that makes 401ks that much more enticing for employees. And then the last two provisions, catch-up contributions will, the amount allowed for a catch-up contribution will increase in 2025. So again, really helping the older generation catch up for retirement. And then there'll be some relaxed distribution rules. And this is really related to COVID. So post-COVID, the Congress has decided that we don't necessarily need to verify every single dollar that's leaving these plans. We understand that there'll be cases of federal disasters, emergencies, situations where employees need access to their plan, their dollars in the plan, and need them right away. And we don't want to penalize them for that. So this will allow for immediate withdrawals of distributions that meet these qualifications without additional certifications and without that 10% penalty.
And again, I'm assuming that if it's in a traditional account, they would be still responsible for taxes that year that they withdraw it. Okay.
Yep, for anyone pre-59. So those are the new provisions. One of the things that the Secure Act 2.0 also included was the ability to launch starter plans. And these starter plans are tied into the pooled employer plan provision of Secure Act 1.0, and as also an alternative, a direct alternative to the state-run plans. So now that we know Congress is really pushing for more companies to launch a plan, what are your options if you don't necessarily want to run your own 401k plan? The first would be to enroll in your state's plan. This would be subject to the rules and jurisdiction of your state. They're all different. Most states are establishing these plans as Roth IRAs for employers and employees. They will typically auto-enroll any new employee to the plan if the company has chosen the state-run plan, and do so with a payroll deduction and funding the accounts. So it'll be all after-tax dollars. Employers will typically be excluded from this plan. So what they're essentially saying is, we don't want you contributing to this. If it's important enough for you to save, maybe think about your own plan. But again, this is different state by state. At the federal level, the federal government has allowed for what we're calling the starter plan. And this would be a deferral only plan. So no employer contributions, no savings, no match, auto enrollment that can range anywhere from 3 to 15%, capped at the same amount as an IRA contribution would be. So right around that $6,000. This would be subject to ERISA. You would need a plan document. So it's not just an IRA, but there is documents required at the plan level. But this would be considered a safe harbor top heavy exempt plan, right? So there's no testing requirements. So it's a no frills way to get a 401k plan launched and at least allow for you to save up to $6,000 without the match. The other provision, or the other new plan option, is the PEP, the pooled employer plan. So this is a multiple employer plan under a single plan provider. Prior to this, when you were in a MEP, the businesses had to have some sort of association with one another. In the case of a PEP now, businesses may be unrelated. Anyone can sponsor a PEP. So these are, the PPP, the pooled plan provider. It could be a bank that wants to launch one for all of their commercial banking clients. It could be an association. It could be a record keeping platform that wants a way to, take away the administrative burden for their small plans. So the PPP, the pooled plan provider, act as the fiduciary for the administration of the plan. And what's great about these new PEP plans is that their plan sponsors are no longer subject to the one bad apple rule, where if one company was doing some nefarious things within the plan, it had implications for all of the other plans in there. So you're almost being viewed as your own entity. Depending on who your PEP provider is, There's flexibility in plan design. And another benefit, particularly for employers that have over 100 employees in their retirement plan, they're required to do an audit. The cost of the audit is now done at the PEP level. So you're sharing that cost with all of the other small plans in here. So same concept, right? It's another way for smaller companies to launch a plan and do so in a more efficient and cost-effective manner.
I just had a question about the PEP plans.
Sure.
How many companies typically have to be in a PEP plan, and is there a size of employees? Can you talk a little bit about that? I'm assuming it has to do with pricing.
Yeah, so that's a difficult one to answer. I wouldn't say that there's any standard way of building a PEP. We've seen PEPs being launched by any number of different PPPs, pool plan providers. So investment advisors, companies like Lodestar have launched PEPs, associations, banks. The cost is normally going to be determined at the provider level. But like anything else, there's economies of scale. So the more assets you can get, the more plan sponsors you can get, the greater the likelihood that you can reduce the cost. But there's no, real rules aside from whatever each provider wants to offer.
And I'm assuming this is a good reason to contact an advisor that deals in group retirement plans who can advise you. This might be a good option for you, cost effective, and meets your needs.
Correct. Certainly, if you're working with an advisor or consultant, speak to them. If you don't have one, talk to your record keeper, your third-party administrator, your TPA, if you have one associated with your plan. Lots of record keepers have launched PEPs as the PPP. And in doing so, many of them have proactively reached out to their smaller clients, stating that there might be some cost savings if you join the PEP versus having your own plan. If your record keeper hasn't had that conversation with you, or your advisor hasn't, certainly reach out to them because it's a worthwhile conversation. So in addition to these new plan options, my favorite provision really of Secure 2.0 is the tax benefits. So tax benefits galore. Secure 2.0 did two things. First and foremost, it enhanced the startup plan credits. So now 100% of the first $5,000 of plan administrative costs are eligible for a straight tax credit, right? This is not a deduction. This is cash for cash. It's only applicable to hard dollar costs. So it's any money that you're being invoiced for and writing a check. You can't apply plan level costs, asset-based costs to that tax credit because those are being paid by the assets of the plan, obviously. And this runs for the first 3 years of the plan. So this is a great way and a great incentive to go out and launch a plan, whether it's a PEP, all of these plans that we've discussed are eligible for those credits. And you can still take certain other deductions as well, right? So it doesn't eliminate all of the other deductions that were in place, but credits are superior to deductions. So this is fantastic. And the other thing that Secure allowed for Secure 2.0 was a credit on employer contributions. And this was aimed particularly for the small business world. So up to $1,000 per employee per year is eligible for a credit. So contributions up to $1,000 per employee per year, and a tiered schedule that phases out over 5 years. So in year one, 100% of that $1,000 contribution or more that you've made is eligible for a credit. In year two, you'd be eligible for $750 per employee per year. Year three would be 50%, so on and so forth until you get to year 5. The definition of an employee always changes from plan to plan and provision to provision. So in the case of the employer contribution credit, an employee is anybody who made more than $5,000 last year that you're contributing to. This does not apply to employees that make more than $100,000. So contributions made to those employers aren't eligible. To those employees aren't eligible for this credit. So it's really aimed at small businesses and getting the rank and file to contribute to a plan. Oftentimes, the way that you make these plans work is by having a safe harbor contribution or safe harbor plan with a non-elective contribution, normally in the area of about 3% being made to those employees that make less than 100,000. And now Congress is rewarding you for making those contributions with this credit. Now, this works for plans with up to 50 employees. If you have more than 50, there's a 2% reduction in the credit for each employee above 50. So what this essentially does is it aims this provision at anybody who has less than 100 employees, because anybody who's in that 50 to 100 range is being phased out. Less than 50, you get the full benefit of the tax credit. So how was that for a crash course in Secure 2.0?
Ooh, yeah, it was good. It was, and I will say to our attendees, don't worry, we will send you a link to the replay of this if you need to review any of this information. We know it's a lot. So look for that in your email.
Yeah, yeah. And just in terms of some best practices, and then we can open it up for any additional questions. The first thing that we would recommend is focus on the mandatory provisions over the optional provisions. Make sure that you're adhering to what has to happen and not worry too much about things that are nice to haves down the road. We see too many plan sponsors get a little too worried about things that aren't that important just yet. Second is to evaluate each new provision to see how it might affect or benefit your plan, right? So as you mentioned, Marche, talk to your consultants, talk to your record keepers, talk to your providers, and do a deep analysis, cost benefit analysis to each of the different provisions, particularly those optional ones, and then make a determination whether or not you want to include those as part of your plan document going forward, and doing so in consulting with all of your professionals too. So as it relates to the tax credits, we are, as part of your disclosures, we have our disclosures. We're not tax professionals. I did not sleep at a Holiday Inn Express last night. I don't pretend to be one, nor am I an ERISA attorney, right? So talk to all of your professionals, make sure that you're adhering with the provisions, and then adopt the ones that make the most sense for your plan. The fourth tip that we would recommend is to watch for updates. So these pieces of legislation are sort of living, breathing documents. As we know more and more about them and we begin implementing them, we realize that some of them actually contradict previous provisions and previous acts, things that are sort of nebulous right now that we don't really know how to adhere to. We'll have updates and guidance from the Department of Labor. We'll have case law and precedents to go after. So don't just think of this as a one-time, I've got my crash course on Secure 2.0 and I'm ready to go. Watch for the updates because they'll be coming fast and furiously over the next 6 months. And then last but not least, seek out resources. So your providers, your partners, your vendors, your consultants will all have resources available to you on the key components of the legislation. And the Department of Labor always does a really nice job of putting out brochures that are easy to read and understand regarding new pieces of legislation. So I think they do a great job with their guidance. Seek those out, make sure you understand these, because at the end of the day, these are all meant to be provisions that benefit employers and employees, right? The Congress wants more people saving for retirement. So they're giving employers incentive to launch a plan via tax credits, reducing the administrative burden associated with plans, multiple options to start a plan in place, and then giving your employees a little bit of a safety net where they can save for retirement, but if they need those assets, they can go back and tap into them with the hope that they won't ever have to do that, right? So all of this is designed to hopefully tackle the retirement savings crisis that we have. And with that, we'll open up to any additional questions.
All right, well, we do have time for a couple more questions that I've received. So here's a good question. Many companies rely on independent contractors for tasks that are not necessarily central, but are important in their company. Are there group retirement options for independent contractors?
Group retirement options for independent contractors. Typically a 1099 contractor will adopt a SEP IRA plan. So SEPs can be a group plan. They can also be an individual plan. So if you're a business owner or 1099, you can launch your own SEP. That's always a great option in that they're relatively easy to launch, both in terms of cost and administrative burden. There is also something called a solo 401k. And there are companies that sort of specialize in those plans. So as an individual, you could actually have your own 401k plan and join a PEP. But most companies, given that those plans are smaller and relatively easy to administer, will either launch a SEP or a 401k plan. And then your job would be to find a provider that maybe does that at the group level for a further reduction in cost.
Can you talk a little bit about highly compensated employees? And the question here was, so if key employees like the business owner or maybe the top salesperson is considered a key employee, but they don't meet that income threshold, are they still counted as highly compensated employees?
That is correct. So highly compensated is anyone that makes over the IRS definition per year or the key employee, regardless of their income levels.
Okay. All right, and then the last question before we have to leave today. New plans have to be established at a certain time of year, is that correct? And maybe can you elaborate on that?
So if I understand the question correctly, in terms of timing of the year, there's certain provisions depending on the plan when it can be launched, funded, whatnot. Plans also are able to determine what their own plan years are. Most companies just use the calendar year, but many can have their own fiscal year. So the answer to that is kind of. It depends on the type of plan, when it has to be launched, when you can launch it, and when it has to be funded for. Some plans you can actually retroactively fund. So my answer to that would be consult with a professional. Once you know what type of plan it is that you're looking to implement, they'll have all the details on establishment dates, notices, and whatnot that need to occur. Marche, I think you're muted.
Sorry about that. One more question. What if you work for a company that does not offer a retirement plan? Even if you're a full-time employee, what are your options there?
Yeah, so employees that are working for employers that do not offer a retirement plan, that's where you'll see some of these state-sponsored plans come into play with mandates. Outside of that, there are other avenues for qualified savings, the most prominent of which is the IRA, the individual retirement account. So you're able to establish one of those, either a traditional or Roth IRA, health savings accounts or other qualified accounts that can be used for retirement costs, particularly healthcare and retirement. So in that instance, speak with an advisor, or you can go on any number of websites and open up an account there and at least start contributing that way.
Well, thank you so much for all this information. On behalf of Advice Chaser, we want to thank James and the organizations that have made this webinar possible today. To our attendees, once again, thank you for attending, and look for an email soon with that link to the replay of the event, as I mentioned earlier. And you're welcome to share that replay with your friends and family or colleagues. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Well, once again, from Advice Chaser, thank you so much for coming, and we'll see you at another webinar soon. Goodbye, everyone.